On May 13, 2026, the Reserve Bank of India issued Circular Number 10, establishing a new framework for digital platforms processing money leaving the country. Previously, under Paragraph 10, the RBI was required to review and grant specific pre-approval for every individual partnership between a bank and a fintech entity. The central bank has now officially deleted Paragraph 10, removing the requirement for these individual applications. This allows non-bank platforms to enter the remittance market as soon as they secure a banking partner, rather than waiting for central regulatory review. However, this shift does not represent deregulation. Instead, the RBI has transferred the burden of oversight from its own offices to the private sector. The new gatekeepers of these transactions are authorized dealer Category I banks, the primary institutions licensed to manage foreign exchange in India. In exchange for faster market entry, banks now hold absolute liability for their fintech partners. If a third-party app fails to comply, the bank is legally responsible. The bank must ensure every transaction follows the Foreign Exchange Management Act and strict Know Your Customer protocols. The central challenge for the RBI is regulating a growing ecosystem of consumer-facing apps without risking the stability of the broader financial system. To manage this, the circular mandates a specific architectural design for every transaction, focusing on transparency and the isolation of user funds. This is the mandated map for every transaction. To move money across the border, a remitter must pass through 4 distinct nodes: the app interface, the dealer bank, and finally, the beneficiary's bank. The process begins at the first node, the digital interface of the third-party app. The app is now legally required to prominently display a name and authorization status of the AD bank that is actually processing the funds. Any foreign exchange rate quoted by the app must include a specific timestamp and a clearly defined period of validity. The interface must also show the exact amount of foreign currency that will be credited to the beneficiary's account. This disclosure must also include the maximum time the transfer will take and the direct contact details for a grievance officer. Under the 2026 rules, these interface requirements turn the app's design into a legally binding disclosure layer. Once the user initiates the transfer on their device, the transaction data officially moves out of the interface and into the execution phase. For every transaction, the third-party platform must now generate an invoice that meets specific, unambiguous criteria. Platforms are now forced to unbundle the exchange rate. They must show the interbank rate and the platform's markup as 2 separate, distinct numbers. Hiding profit margins within a single blended exchange rate is now illegal. The final invoice must also confirm the total amount remitted and state the maximum time, in hours, until the funds arrive. Because the AD bank is liable for the transaction, they are now required to audit these invoices to ensure the fintech's revenue model complies with the law. This requirement forces platforms to compete based on their actual service costs rather than hidden fees. While data moves between the app and the bank, physical capital follows a restricted path. The circular's ring-fencing clause dictates how these customer funds must be handled. Funds must travel exclusively from the remitter's bank to the beneficiary's bank account, completely bypassing the third-party app. At no point in the transaction can user funds ever enter the accounts of the fintech platform in India. This ensures that if the fintech startup faces insolvency, the user's money remains secure within the regulated banking system. The AD bank is responsible for ensuring the money arrives at its destination within the promised timeframe. By keeping the money out of the app's hands, the regulation isolates the user's capital from any volatility or failure within the startup. Beyond the safety of the capital, the circular also addresses the protection of personal information. The bank's liability extends to data security. They must verify that the app handles and stores customer information according to regulatory standards. Apps cannot collect data passively. They must obtain explicit prior consent from the remitter. The circular also mandates that data collection be need-based, limiting the information a platform can legally request. Both the bank and the fintech must comply with the provisions of the Digital Personal Data Protection Act. Furthermore, the bank is tasked with ensuring the app meets the RBI's cybersecurity standards. This effectively requires banks to act as tech auditors, evaluating the back-end code of any partner before allowing them to process transactions. When we look at the broader landscape of Indian finance, these rules change the dynamic between traditional banks and emerging fintechs. While the RBI has removed the bureaucratic hurdle of pre-approval, the high stakes of liability mean that finding a willing banking partner is now more difficult. Banks are forced to act as strict gatekeepers, knowing that any failure by their partner becomes their own legal and financial crisis. Consequently, bank contracts now require fintechs to grant full audit rights and maintain bank-grade risk mitigation frameworks. This will likely lead to a market dominated by a few established fintechs that have the resources to meet these rigorous compliance standards. The ultimate goal of this framework is to protect the remitter. It removes hidden costs by mandating the unbundling of fees and total transparency. By ring-fencing funds, the circular ensures a startup's risks never endanger the user's capital. Every remitter now also has a formalized grievance pathway directly with the dealer bank if a transaction is delayed or mishandled. The RBI has replaced a centralized approval process with a decentralized system of high-stakes accountability, placing the responsibility on banks to build a more transparent bridge for cross-border capital.